But take all your money, buy Bitcoin, then take all your time, figure out how to borrow more money to buy more Bitcoin, then take all your time and figure out what you can sell to buy Bitcoin. And if you absolutely love the thing that you don't want to sell it, go mortgage your house and buy Bitcoin with it. And if you've got a business that you love because your family works for the business, it's in your family for 37 years, and you can't bear to sell it, mortgage it, finance it, and convert the proceeds into the hardest money on earth, which is Bitcoin.
Well, this is Michael Saylor, CEO of Microstrategy, recommending to put everything you have into Bitcoin and to even take on leverage to buy more Bitcoin. And he did this interview when the cryptocurrency was trading for $56,000. Well, I hope he made use of some financial disclaimers, because despite being hyped in expensive Super Bowl ads and in the Matt Damon "The Fortune Favors the Brave" commercial that has been viewed by over 18 million viewers on YouTube, cryptocurrencies around the world are having a very rough time right now. Bitcoin is down 71% from its peak in November last year, and Ethereum is even down 82% over the course of just 11 months. One of crypto's largest venture capitalist firms, 3AC, is facing insolvency, which could spell a disaster for the entire space. TerraUSD, a stablecoin which is intended not to fluctuate in value, imploded last month, losing almost all of its value. The Terra LUNA coin has fallen from a peak of more than $117 per coin in April 2022 to barely 1/100th of a cent. Crypto lender Celsius paused withdrawals as too many investors tried to cash out simultaneously, causing even more panic across the industry. And on June 14th, Coinbase announced that they are going to lay off 18% of their workforce, and many other companies like Robinhood and Crypto.com have also announced significant layoffs or hiring freezes. So, to sum up, as the New York Times reports, the crypto world went into a full meltdown this week in a sell-off that graphically illustrated the risks of the experimental and unregulated digital currencies. And in this video, I'm going to explore the idea that despite many cryptocurrencies being down 50, 60 or 70%, the probability of another 50% decline, so further price declines, may have just increased. And so without further ado, let's get started. So, the idea that the crypto crash is not over yet and may actually accelerate was first articulated by Nassim Taleb, investor and author of the famous book The Black Swan, who tweeted on June 12th, "Finance 101, something like Bitcoin with purely circular attributes, which includes no yield, becomes less attractive at a lower price. In a path-dependent way, a fall from grace." And another well-known FinTwit investor, mostly borrowed ideas, he shared a similar view when he tweeted one day later that when a free cash flow generating company is down 50%, the probability of another 50% decline likely decreases. When a non-cash generating asset, such as crypto, is down 50%, the probability of another 50% decline likely increases. So what do these two brilliant minds actually mean here? Let me explain. Taleb used the term yield in his tweet. So let's first of all quickly explain what the term yield actually stands for. Yield is a return measure for an investment over a set period of time, and it is expressed as an annual percentage based on the current market value of that asset. Essentially, yield refers to the earnings or cash flow generated and realized on the investment over that period. A dividend yield, for example, tells you the percentage of a company's share price that it pays out in dividends each year. So if, for example, a company, let's call the company XYZ, can be bought for $100 a share, and the company pays an annual dividend of $2 a share, well, then the dividend yield would be 2%. $2 divided by $100. More generally speaking, if you adopt the mindset of an actual owner of a business, yield tells investors also how much cash they will earn each year relative to the market value or the initial cost of their investment. If, for instance, a business with a market cap of $100,000 annually generates $9,000 in free cash flow. Well, then you got a free cash flow yield of 9%. Now, cryptocurrencies are so-called non-productive assets, meaning they do not produce any underlying earnings or cash flow. So as an investor, you don't receive anything. And thus, any return an investor wants to return or wants to make must come from someone else buying their shares or their cryptocurrencies at a higher price. This is not the case for productive assets, where, and please pay attention now, a lower price actually increases the yield and which thus in a way creates a floor to the price to which the asset can drop. And again, let me try to illustrate this with an example. Let's assume you want to buy an ice cream parlor in San Francisco. And let's use some very simple and rounded numbers. Well, if the ice cream parlor that you are looking at generates $1,000 in profits, in free cash flow, forever and every single year, and let's also assume that the business is not growing. Well, what would you be willing to pay for that entire business? Well, if you want to earn a 10% return, the math is actually quite simple. You can pay $10,000 for the entire company, and that's the so-called intrinsic value of that business. And of course, the free cash flow yield for this fictional business generating $1,000 a year would be 10%. Now let's suppose that the ice cream parlor is actually a publicly traded company trading on the New York Stock Exchange. During the recent stock sell-off, the market crash, the stock's market capitalization was also impacted and dropped 50% to $5,000 a share. So we are assuming there is only one share. So what just happened to the yield of that business? Well, if you can buy the entire business for $5,000, all of a sudden the free cash flow yield went to 20%. Or put differently, if we demand a return of 10%, the stock now trades 50% below its intrinsic value. So with that said, let's now take another look at the mostly borrowed ideas tweet. When a free cash flow generating company is down 50%, the probability of another 50% decline likely decreases. As you can see in our example, when the ice cream parlor trades at a free cash flow yield of 20%, that's the return that investors are going to generate over the long term. Well, then the 50% price decline just created a floor to the price. A 20% return is incredibly good, and so if an asset declines in price, leading to higher future expected returns, eventually some investors will step in and buy the business, and then the price over the long run will revert back to its intrinsic value. So as the price decreases, the risk decreases as well. Cryptocurrencies, on the other hand, well, they offer no yield, which explains the second half of that tweet. When a non-cash generating asset, such as crypto, is down 50%, the probability of another 50% decline likely increases. Cryptocurrencies have no intrinsic value. Just ask yourself the following question. What is the most that you would be willing to pay for a crypto coin if you were stuck with that coin for the rest of your life? Well, chances are you wouldn't want to own it at all, and thus you wouldn't want to pay anything for that asset. The reason why most crypto investors own crypto coins is because they believe that sometime in the future someone else is willing to pay more for that coin. Now, based on this, it may make more sense now that paradoxically, belief-based assets like cryptocurrencies become less risky as the price increases and more risky as the price decreases. Another way of putting it is that Bitcoin only has value as long as other people think it has value. And once more and more people start believing that Bitcoin has no value, like right now maybe, so do the chances of a continued sell-off go up. And again, so in contrast to publicly traded businesses, there is no floor to the price of belief-based assets. Now, to wrap it up here, I would say that personally, I'm really not much of a crypto guy. And all I'm saying here is that personally, I would never feel comfortable owning a non-productive asset. I'm not saying that the price of Bitcoin will never go up again. Bitcoin actually experienced significant drawdowns before. And in fact, the current sell-off, I think, is only the third or fourth worst price decline over the course of the last decade. And I actually discussed the idea of Bitcoin having reached critical mass and being too big to fail in this video right here. So if you want to learn more about this asset class, watch this video next. Take care.